Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday the 12th of November 2019 and we're broaching a subject we cover only occasionally. The question and issue of equities and an investigation into what fund managers are actually doing with the funds under their management and by implication indicate what the potential impact on gold and silver prices are likely to be. So let's investigate. We have in the past month produced a few podcast videos here on YouTube highlighting the fact that we have been, for a while, and continue to be, confident that equity markets are back in a bull phase. Possibly a last bull leg, but nevertheless a phase which is likely to continue for a number of months at least. Our view has been supported of late because of continuing upsides in stock market indices reaching multiple all-time highs, especially the US markets, and this at a time when those who take a differing view have guaranteed economic and dollar collapse anytime soon. Now, we're not going to name them, but you know who they are. One of the concerns we did have a few months ago, and something we watched and continue to watch very closely, was what fund managers were investing in and how they were apportioning these funds between investment classes. We've repeatedly pointed out that whilst bonds or treasury yields were falling and therefore becoming less attractive, investment managers were looking at other safe haven assets to invest in, not to totally replace them, but to provide additional cover and in some cases potential capital appreciation, which is why gold and silver have, of late, proven attractive, and we have seen their prices rise as a consequence. The one area, though, which is often overlooked is the question of cash. How much of their assets are fund managers holding in cash? You see, when in times of doubt or uncertainty, fund managers often find themselves in a position where they have to decide whether to take profits to protect themselves against a downturn, particularly in the equity or commodity markets, or to risk those profits against the potential of increasing ones. Once the decision to take profits, though, is made, and particularly out of one asset class, they then have to determine where to place those monies. Now, in principle, and we base this on over 40 years of advising clients ourselves, this is not normally a difficult decision to make, because generally one finds asset classes that have performed extremely well and others that have performed badly, but historically run in cycles. So even though you may not get the timing perfectly right on the whole, moving from one to the other, that general investment decision tends to work out quite positively. However, in recent months, this has not necessarily been the case or so clearly defined. You see, equities have been at or close to all-time highs. Gold and silver have been at multi-year highs in dollar terms and all-time highs in other currency terms. Bond prices have risen because yields have fallen. Property has generally done well, and the world is faced with a looming recession. So what we have seen fund managers and investment managers do is to take those profits and essentially hold them in cash. We often report that Warren Buffett has been increasing his cash holdings well in excess of $100 billion, but we should not get too caught up with Buffett because his position is, of course, exceptional. But other fund managers, on this occasion, have also been holding increasing levels of cash, and especially in relatively safe currencies such as the US dollar. Safe compared to other currencies, that is. Well, that has been the situation until recently. It is reported on Reuters today that, quote, fund managers' cash levels dropped in November to their lowest level since June 2013, as investors grew more optimistic on global growth. A key investor survey showed on Tuesday, unquote. The key investor survey they are talking about is the monthly BAML survey, which stands for Bank of America Merrill Lynch's monthly investor survey of global managers, who between them manage more than $500 billion worth of assets. Now it reports that, quote, cash levels fell to 4.2% from 5% the previous month, their biggest monthly drop since US President Donald Trump was elected in November 2016, unquote. Now this is significant, especially as the report showed that global optimism surged by the most in 20 years to an 18-month high. Now, in the interests of balance, we should also report that UBS Global Wealth Management have, according to Joanna Ossinger of Bloomberg, reported this, quote, a majority of rich investors expect a significant drop in markets before the end of next year, and 25% of their average assets are currently in cash, according to a survey of more than 3,400 global respondents. The US-China trade conflict is their top geopolitical concern, while the upcoming American presidential election is seen as another significant threat to portfolios, unquote. It goes on to report that, quote, 60% are considering increasing their cash levels further, while 62% plan to increase diversification across asset classes, unquote. Now, these investors are broken down into individuals with at least $1 million worth of investable assets. However, these same investors, or at least 70% of them, are optimistic about investment returns over the next 10 years. An interesting dilemma. However, our money is on the institutional investors as opposed to the individual investors, or at least for now, moving into 2020. So what are the implications for gold and silver? Well, at the time of writing, gold is currently standing at $1,454, down just $4 since Monday, but down almost $60 on its recent peak on the 2nd of November, and some 3% down in this last quarter. Silver stands at $16.79, unchanged since its opening on Monday, but is $1.33 down since the 2nd of November, and is down just 1% this last quarter. Considering their rise this year, they're holding up very well. But of course, as equity markets rise, more and more funds may leave these safe havens, at least for a short time, as investors gravitate towards yield and what they construe as additional potential capital appreciation. That said, and we should not rule out this entirely, it is quite possible that both could rise, equities and precious metals, with the latter performing less well, but well enough to cater for those private investors who may be less confident about the future. Now, we have already highlighted in a video entitled Gold Demand Up Thanks to ETFs, published on the 8th of November, that if it were not for major gold ETF inflows, then the demand versus supply equation for gold would be looking quite poorly this last quarter, especially as coin and bar demand for gold was down a significant 50%, and gold supply was up by 4%, primarily due to recyclables. From an institutional investor's point of view, it does appear that their transfers from cash to equities are more or less guaranteeing another bull run in stocks. And whether this is short-lived or not, only time will tell. However, it does indeed present an opportunity for those who are still light in their portfolios of physical precious metals to consider topping up. But we would warn paper traders to simply beware because their underlying price, for the moment at least, is not as certain as those appearing on Kitco News or listening to other harbingers of imminent economic doom are gaslighting. What do you think? Do share your thoughts. And before we go, I would like to personally thank everyone who has offered their condolences on this channel for the recent demise of my father. And I have shared these with my mother, who is equally as touched by such kind words and sentiments from you. It is truly appreciated and show that even those who may disagree with us on times, as well as those who do agree with us, we all share a common humanity. Thank you for listening. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.